the day that you started on Wall Street?
I do. It was June of 1987, but you're making me seem like a dinosaur now. You start right with a dinosaur.
June of 1987. I started in August of 89, so we're contemporaries. What's happened in the last 35 years, and we counted this backstage, there's been 10 or so calamities over the last 35 years. And so I want to start out by asking you, given the nature of the world and the constant calamities and the up and down cycles of the markets, is the endowment model, is that dead, Joe?
So I don't think it's dead. I think that the principles that the endowment model was founded on are still very much alive today. And they're pretty basic in terms of investing. If you think about the power of diversification, if you think about capturing the illiquidity premium, if you think about compounding for the long term, and really the compounding for the long term is at the heart of your question. So Anthony, maybe you can riff with me a little bit. It's June of 1987. I'm right out of college. In October 87, there's a crash. Got the savings and loan crisis. Help me out here. What else we got?
Savings and loan crisis. You had the United Airline merger talks break off, which caused like a 7% drop in the market. Then you had the Gulf War in 1990, which led to a recession. We had the 1994, this is really going back, David Askin. The Fed actually in 1994 raised rates 200 basis points over a 2-month period, February into April, which caused a mortgage crisis calamity. Then we had the long-term capital management crisis in 98, the dot-com and Y2K crisis.
I mean, do you remember Y2K?
Yeah, sure.
It was one of the craziest things that people were afraid to fly in planes because they thought the planes would go down. So, okay, we're
We had all that
Y2K.
technology investment that led to the NASDAQ boom, the Web 1 boom. You had that crash. Amazon went from like 116 to 8. Then you had the World Trade Center terrorism attack. And then, of course, you had the mother of all crises, the global financial crisis in 08. And now you're dealing with COVID and
Inflation gate.
Yeah, inflation gate. So 11 crises over the 35 years that you started in the industry.
But if you put $1 in the S&P, it's worth $34 today. If I was smart enough to put it in the NASDAQ, it's worth $84. And when Anthony and I were talking about this backstage, you told me the story of your Microsoft.
Oh, yeah, this is
incredible.
Embarrassing story for me. I bought Microsoft for my kids. It was 27 at the time, and I was working at Goldman Sachs, and I bought $1,200 worth of Microsoft in early part of 1991. And for whatever reason, I moved out of Goldman, started my own business. They lost track of me, I lost track of them. The account lay dormant at Goldman Sachs for 30 years. And finally someone got in touch with me and they were like, you know, you have an account here at Goldman Sachs. I said, okay, I didn't realize that. And the $1,200 of Microsoft is worth $71,000. And I would have sold that like 17 or 18 times had I had known about it. And so it's a big lesson on being a long-term investor. You know, the dead people at Charles Schwab, apparently if you Google this, what are the best performing accounts at Charles Schwab? It's the dead people. Now, the dead people don't look at their accounts, you know, unless they, of course, have a Ouija board. But
well, there's always a reason, right, to sell something.
So you get asked this all the time. You guys are running, you know, what's the number now for BAAM?
So we're at about 80 billion, about 300.
All right, so you're 80 billion, and overall Blackstone is how big now?
Over $1 trillion.
It's over $1 trillion. So you're one of the largest asset managers in the world. Private equity does well for a reason. These endowments do well for a reason. So what's the crystallized principle for you when you think about this industry?
In terms of Blackstone in general, or in terms of the endowment?
If you were going to leave one nugget for everybody in this delegation to learn from your 35-year experience about investing, what is it?
I think it goes back to what we were just talking about, which is don't get scared out of the markets. Think about long-term compounding and what gets in the way of long-term compounding. Taxes get in the way of long-term compounding. Emotional decisions get in the way of long-term compounding.
Media pressure.
Fees get in the way of long-term compounding. So I think that's the principle. As you get older, you get less reactive to the short term and more focused on maintaining that long-term compounding stream.
So let's role play for a second, though. So I'm one of your clients. I come in, I'm worried about the debt ceiling crisis. I'm worried about the war in Ukraine. I'm worried about the tension between the United States and China over things like Taiwan, but also over trade and the microprocessing chips, this whole situation, deficit spending in the US. I say, so Joe, what do I do?
And so I would encourage you to focus on the long term and to have a portfolio that is not excessively leveraged. The more staying power that you have as an investor, the more you can ride out these cycles, the more you can dollar cost average, the more you can think about the long term. The more short-term focused and leveraged that you get, the more difficult it becomes. And I think this goes back to the power of the endowment model and just and thinking about it. I don't think there's anything magical about the endowment model, but I do think they do a good job at not worrying as much about vol and investing for the long term. And I think that's one of the most important things I've learned.
Been at Blackstone now for 3 years. Tell us about Blackstone. What did you think of Blackstone before your arrival, and what's your observation of the organization now that you've been there for 3 years?
I get this question a lot. I would say I've never been in an organization in my life with such high standards. And by those standards, I mean the expectations for what you do in the pursuit of your craft is extremely high. The teamwork and the communication and the transparency and the way they set the firm up it encourages risk-taking, but responsible risk-taking. And the second thing, Anthony, is the amount of data and deal flow that you see from the brand is such a competitive advantage. If I could have run Brown's endowment at Blackstone, Brown would have a lot more endowment.
You were on stage with me at SALT, New York in May, and we talked about a paradigm shift. The Federal Reserve was moving from a zero interest rate policy into something that we call quantitative tightening, where they were raising rates, but also unwinding their balance sheet. Give us an update on your view of quantitative tightening, and obviously the markets reacted favorably today,
Yep.
At least Tuesday, I should say, in New York to the inflation data. So where are we now in that paradigm shift?
So the quantitative story just keeps continuing. People don't really talk about it that much, but it's $95 billion a month, and since we met, the balance sheet has gone down from, call it, 9 trillion to 8 trillion. So it's happening in the background, and you can see, if you look at things like M2 or you follow the Fed, you can see that quantitative tightening is affecting us, and we're going to get to that. So quantitative tightening is happening, yes. The regional banks really have been, I want to say, broken by the rapid raise of interest rates that the Fed did. So their liquidity there is tight, and you can see that also. And then the third thing that people aren't really talking about is the fact that banks are losing deposits, and they're going into money market accounts. So they're going from bank balance sheets into money market accounts, and that's the reverse, right, of the money multiplier effect. So you have all that, and then we have a wave of refinancings coming, call it $2.5 trillion over the next 3 years, of loans that were done in a zero interest rate environment that need to be refinanced. Now, you might think that I'm super bearish. I'm not. It just requires a different playbook, and we can talk about that. But people ask me, like, Joe, but wait, you're describing all this QT. Why isn't it hitting? Like, what's happening? And the reality is, on the other side, and I'm focused on the US right now, but this story is applicable in Europe also. There is an immense amount of fiscal stimulus. Programs like the Inflation Reduction Act, the CHIPS Act, have injected literally billions of dollars. And if you look at things like construction spending year over year, it's up 100%. So these two forces are battling each other. And if we go back to the academics, they're saying there's about an 18 to 24-month lag between when monetary policy kicks in and when you feel it. But it's really a battle of these two forces.
So let me play devil's advocate for a second. So we're running huge deficits in the U.S. The deficit popped recently as a result.
1.7 trillion?
$1.7 trillion. Governor Romney, now Senator Romney, put out a note earlier this month talking about 120% debt to GDP ratio in the United States. That gets you into sort of a warning level on the economic dashboard. The Fed is cutting its balance sheet. The Chinese are net sellers of treasuries. Other countries on the margin, the industrial countries, have been net sellers of U.S. treasuries alongside of the Fed. Does any of that worry you, or how do you think that manifests over the next 24 months?
Yeah, I think any investor has to put in perspective the relative changes in how our government is financing itself and how it can continue to finance itself. But it's the largest market in the world. It's very robust, and I don't see it changing now. But I will say that people will focus on it with regard to the dollar, but it's not something that keeps me up at night.
Well, what about the national, speak for about U.S.-centric for a second, but it's also somewhat pervasive in other countries. There's a universal anxiety for middle and lower middle class people as a result of what has happened post-COVID. And so a middle class person who is making money pursuant to their hard labor and doesn't own assets is finding their purchasing power is going down heavy, their disposable income is shrinking, the price at the pump has gone up a lot, and if you gave them $1,000 last year, they've got $920 worth of purchasing power today. And so we've turned a generation of people who were once working class aspirational people into now economically desperational. Does that worry you?
It definitely worries me, and you can see it when you start to look through this lens that you're presenting in unionization, in demands for higher wages. And I think what happens in capitalism is there's a trade-off between capital and labor, and each have to have a fair share. And you're pointing out that the middle class hasn't had that fair share for the last decade or so. And so that is something that is going to have to adjust for the long term. And it doesn't naturally.
Not to interrupt you, Joe, but explain that, because I think it's very important. When we talk about the fair share, that's the economic rent or the profit distribution, percentage-wise, between the capital and the labor. What's a fair share for labor?
So it's different for every industry, but what I would say is you have to have real wage growth for workers over longer periods of time. They have to participate. And if capital is winning too much, you'll see large income disparity, which many parts of the globe are experiencing now. And then it just, the great thing about the capitalist system, it'll readjust. And you're seeing that, whether that's, in states mandating higher wages, or whether it's unions helping the workers to be treated fairly. And I think the name of the game in all business, and we all know it, is whoever the counterparty you're dealing with, everyone has to feel like they have a good deal and a fair share. Otherwise, it's not sustainable.
One of the states that you, neighboring state to where you grew up, state of Massachusetts, is voting on a 4-day work week. Is that part of that?
It's all part of the same phenomenon. And these things reverse themselves over long periods of time. And so it'll have implications for margins and other things for business. But if you think about it, there's a lot of other forces too, which are operating the other way. AI, as an example, taking costs out. So again, worker productivity making margins higher. So I don't want to have a doom and gloom scenario where I think corporate margins are going to get hammered, but they're just different forces.
Talk about the competitive advantage that Blackstone has in terms of global relationships around the world, benefit from information coming in from LPs, GPs of your competitors that you're close with, the data that Blackstone's able to get from all of these private companies in your
We have 240
portfolios.
private companies, Anthony, and over 12,000 real estate assets. And what blew me away when I went to the firm is I think we have now 80 people in data science. But you can have all that data, but it's how you sort, cull, and utilize that data. And I think the firm's done an amazing job on it. And if you think about some of the public stances that the firm has taken, for instance, John Gray was able to go prior to inflation taking off and telling people that inflation was going to rise pretty dramatically. And he was seeing that in the rental increases across the globe and in our properties. So I would say it's a key competitive advantage. It helps you make money and get proprietary data. So we actually have the data.
What's the best opportunity that you see right now in the investment landscape?
So I think in credit, you're getting equity-like returns with credit-like safety. And so it doesn't need to be private credit. It can be public credit. But it's all a function, again, of not enough capital in the system. And so with the regional banks tight in the U.S., even the top-tier banks are tight. It's opening up opportunities. So why are CLOs spreads as wide as they were in 2008? How come they haven't closed? So I think if you focus on debt, you're gonna do very well. It's not something that's going to be temporary.
Joe, I know you're a big reader. Tell us about some of the books that you've read recently that have had an impact on the way you think about investing or how you're managing the business or thinking about the globe, the geopolitical situation, et cetera.
Well, we were talking a little bit backstage. I'm a big fan of Axios. And Axios is a daily newsletter. It comes out and started by Jim VandeHei. And he wrote a book called Smart Brevity, which I absolutely love. And it's not necessarily a business book, but it's a book that helps you to be really clear on your points. And I think it's something that my partners at Blackstone are really good at, and certainly something I'm trying to improve, is get your message across really succinctly. So that would be a book that I'd recommend to everyone.
Okay, so
it's not going to help you with interest rates or where to make money.
All right, so let's play Smart Brevity. Okay, we have a little bit of time here. We're going to play Smart Brevity. Give me some Smart Brevity, your analysis, U.S. relationship with China, where it is now, where you think it's going.
So I should flip the question to you because you're a student of this. I will tell you that we have been long-term investors in China. We continue to have people on the ground there as well as Hong Kong. We at BAAM have doubled our efforts in Hong Kong, and we're very bullish in the long term for Asia. We're going to have bumps in the road, and I think one of the reasons that you have bumps in the road is during the COVID period, we weren't being able to get together, the China and the US, to just talk. And when you talk face to face, things get better. When you're dealing over Zoom and you can't read body language and you can't spend time with people. So, but I'd love to hear. I'm going to flip it to you.
Well, I'm not as smart as you, so I likely can't be as brief. But here's what I would say: that we are so much better together and so much better, more globally interdependent than separating. And I think that the competitive tension right now, we have to figure out as a group of people, the Chinese and the Americans, a way to diffuse that tension for the sake of humanity. You know, there's a great speech that Jack Kennedy gave in the 1960s, and unfortunately, we'll be commemorating the 60th anniversary of his assassination here in November. He died November 22nd, 1963, but he reminded everybody in a great speech that we're all breathing the same air, we're drinking the same water, and whatever our ideological differences are, we have to figure it out and we have to come together. So I'm hoping the Presidents Xi and Biden conversations today will lead to more constructivism on that part. I will say this, though, if you like reading, there was a great book a few years ago called Destined for War by Graham Allison. He's the dean of the Kennedy School of Government. And the book is sensational about rising superpowers contesting the existing power structure. And there's a theme in the book called the Thucydides trap, which is about what happened in the Peloponnesian War. Anyway, the reason I'm bringing the book up is that President Xi was carrying it with him in April of 2017 to Mar-a-Lago when he was meeting with President Trump. And so if you read the book, you'll see that 16 episodes where the superpowers were sort of, one was rising and threatening the power structure. 12 of the 16 times, unfortunately, the world went to war. And there's ways to diffuse that. And I think we got to be more focused on that than the sort of neurotic nationalism. Not brief enough, but those are my thoughts. But
I think if we went back to our original point, if you put $1 in the Chinese market right now, I guarantee you in 30 years it'll be worth more.
Yeah, listen.
I don't know if it's going to be 30 times, 80 times, 100 times.
I think we have to acknowledge that we can have different systems and both have amazing innovation, amazing growth and opportunity. And so I'm one of the more moderates, at least in my party, as it relates to the current hawkism, although it's bipartisan now, the hawkism, which I'm not in love with. Okay, smart brevity. Let's talk about the U.S. stock market. Where do you think it's going in the next 12 to 24 months?
So I would say QT is a headwind in general. And if you look at, I don't know, let's say there's 10 or 12 indicators, price to sales, price to book, price to cash flow, those types of indicators, they're sort of in the top quartile in terms of expensiveness. So often you'll go through periods of time, and this is somewhat interesting, where markets can just go sideways as valuations catch up to themselves. They don't necessarily need to go down. You can trade in a tight range. Our chairman, Steve Schwarzman, when he started on Wall Street, stocks didn't go anywhere for 13 years. And this is part, Anthony, of what I think people have a lot of hindsight bias because they're so used to the QE like paradigm. And stocks were going up. The Fed had, you essentially had a put. And so we got very used to every year equity returns going up. And if you look at 2022, right, probably the worst year in a long time for a 60-40 or a 70-30 portfolio. And what you're seeing is in a non-QT world, stocks and bonds are actually correlated about 62% of the time. But during QE, they were uncorrelated. It was the perfect framework. It was a perfect time to make a ton of money by being long equities or equity-related things. Now, with headwinds to, I think, all markets, right, you need to have other strategies like absolute return that will create a different engine for your portfolio, so you just won't be left with equities and bonds. And this is the secret, you know, obviously diversification is the only free lunch. So I would add in absolute return. I would still be doing PE. I would still be doing my other things. But there's lots of nuance in this new world. And the model that worked in the past, you have to change it. The principles don't change, but the way you implement has to change to be successful.
Let's shift gears for a second and talk a little bit about the digital asset and the digital property space. When you were at the Brown Endowment, you added Bitcoin to the endowment's portfolio. Tell us why you decided to do that.
Yeah. So I think we were talking a little bit about this. Bitcoin is a very hard asset class for the U.S. American population to understand. There's a lot of skepticism around it. And I think part of that is because people are confused about its role. But if you live in other areas of the world where you're worried about bank failures, you're worried about confiscation, you're worried about massively high inflation, it's an asset that that's very reliable. How many times have you not been able to trade your cryptocurrencies? Have the exchanges ever gone down? The answer is no. So for certain people, I think it's a very powerful tool in diversifying. I don't think from an institutional standpoint that it's something that really has the regulatory framework yet for people to feel comfortable. So what do you need for an asset class to emerge? You need it to trade. So how much is, for instance, Bitcoin trading a day now? What do you think? 60 billion?
That's what I would guess.
60 to 60 to 70
10%
billion?
of its market capitalization.
Right? So we have that, check, but we don't have regulations. We don't have standard regulations across the globe for it, which makes it hard for institutions to embrace it. I should flip that to you because you've been studying, actually great year, right? Is it the number one performing asset class?
Yeah, well, yes, but I mean, I was on this stage last year when Sam was Bankman-Fried was declaring bankruptcy and things look quite bleak. I think it's another lesson. You have to stay in things. This gentleman in the front row here has, I think, a HODL hat on, right? Is that a HODL hat on? Right, you're going to stay in it, right? I mean, that's ultimately what it's about. And thank God we stayed in it because it's performing well. But I want to ask a macro question. Do you envision a time where something like Bitcoin, digital property, is in an overall portfolio? When you step back as an endowment investor, an investor for yourself, an investor for Blackstone, I obviously think our friends and our contemporaries at BlackRock believe that, which is why they've applied for an ETF. Do you see that as a piece? Could be a small piece, but do you see that as a piece?
I think this ETF,
someone's model portfolio. I do, but I'm just.
I do too. I think this ETF is a good test case. How do you handicap?
Well,
maybe give people the background.
I've seen the rug pull so many times from the current U.S. regulators. Unfortunately, in the United States, the financial services industry is being overseen by Senator Warren, and she has a very negative view of Bitcoin, and her acolyte, Gary Gensler, has a very negative view, which is interesting because he used to have a fairly positive view when he was a professor at MIT. And so they don't like it. He continues to lose court cases. He's lost the court case against Ripple. He lost the court case against Grayscale. And so I think there's a lot of pressure now from a legal perspective to make it happen. And so the marketplace is anticipating that it will happen by the end of December. Cathie Wood's application is, I think the deadline is January 10th, so the marketplace is seeing that. But I'm always skeptical about these things because they could do a rug pull here or there. We'll have to see. I don't think it overall affects the price long term, though. I think it's going in the right direction. We've got about 30 seconds left, so I want you to go back to what we originally talked about, which is the theme for Joe Dowling. What's the next decade look like for you in terms of investing? Same as before, or what adjustments are you making?
No, Anthony, it's a new paradigm. QE is over. People think that it's coming back. We're in a QT world. It's a new paradigm. Doesn't mean that you have to throw out all of the elements of the old playbook. So I'm very bullish on private equity as an example, but a different aspect of private equity, which is before you could make money because the equity markets were going up and you were getting multiple expansion. But if you think about it now, you want to focus on firms and people that can actually affect those cash flows, change those cash flows for the positive. And then even if you're buying at the same multiple and selling at the same multiple, you can still make a lot of money through the pay down of debt and the increase in those cash flows. And you have control. You're not buying a minority stake. You have control. You can change management. You can apply your playbook. But that's very different than investing money with a small or even mid-cap PE firm that can't do that because they don't have the resources. So I think the next decade is going to be about quality companies. It's going to be about cash flows. I say welcome back GAAP and good accounting. It's going to be a back-to-basics market.
Ladies and gentlemen, Joe Dowling. Joe, thanks very much. Great
Thanks,
conversation.
Anthony.